Right, good afternoon everybody and welcome to today's webinar, Managing Financial Risk in a Brexit World, brought to you by Social Housing Magazine in partnership with Finance Active. I'm Luke Cross, editor of Social Housing. It's great to have you all on board. Of course, we're not quite in a Brexit world yet, so there might be some crystal ball gazing today, but we've certainly already seen some major political and economic shifts since the 23rd of June, and we have an excellent panel to offer their view on what's happened so far and how they're responding to and planning for the many unknowns. A key theme today is how housing providers are continuing to deliver much needed housing and community services in uncertain times. Before we get stuck in, just a few admin pointers. Hopefully you all logged in okay and have your control panel open now, which enables you to ask questions even. If you haven't, just click on the red arrow at the top of the panel. We have 3 presentations for you, then we open up to a discussion and Q&A. Please feel free to send questions over at any point. I'll be watching them as they come in and then putting them to the panel. This is a public forum, so unless you state otherwise, we'll probably mention first names when putting the questions to the panel. Today's session will be recorded and then uploaded to our website, so you'll be able to listen back to your heart's content. And lastly, some of today's topics will feature at upcoming events, including our road shows in October and our annual conference in London in November. You can see more details on those on our website. So on to the session itself. When you look at what's happened really since the budget last year, 2015, through to now, change is the one constant. Extensive welfare reforms and the new Housing and Planning Act, but housing associations seems to have responded well. The Brexit vote and subsequent financial markets volatility, but swift action from the Bank of England, and we've seen some housing associations taking advantage of record low rates to secure funding. Plus, we haven't seen the housing market shock some were predicting, albeit the predictions are for the real impacts in 2017. A new government, another big unknown, but possibly some encouraging messages from the Housing Minister, Gavin Barwell, at his maiden conference speech yesterday, when he said helping people into home ownership should not be at the exclusion of all other tenures. How much we should read into this, I'll leave you to decide. However, one thing remains the same: we still need housing. So with the goalposts changing at every corner, how do we fund and deliver it? What are the key risks that need to be monitored and managed? And how do you prepare for so many unknowns? We have a panel with a wealth of insight and expertise. We have Matt Cooper, Tax and Treasury Director at Places for People. PFP have a diverse Treasury portfolio and business strategy, and recently issued the biggest own name bond ever seen in the sector. Peter Armstrong, Treasury Director at Family Mosaic, will give a view from a London G15 association, which has a commitment to affordable rent levels in the capital, as well as their care and support in older residents and provision. Nick Fletcher, Head of Rate Solutions at Lloyds, will be running us through what the markets are doing, interest rate risks and derivatives positions. And Conor O'Flynn, Managing Director at Finance Active, which offers debt management tools to housing associations. Conor, a quick hello from you.
Good morning, everyone. We're very pleased to be sponsoring this webinar targeted towards Treasury professionals and to open the discussion on the subject. We're continuously told by Her Majesty's Government to keep calm and carry on. The underlying message behind this is to be prepared. The origins of this catchphrase, where everyone played their part, is well known. What is little known is that the original leaflet, produced in 1939, then listed 14 questions and answers on practical measures to be taken. Unfortunately, today we don't have the simple steps as defined at the time. We do, however, have tools at our disposal to simulate the possible outcomes. Today, this webinar will hopefully help housing associations to best address the situation and provide insights to what we should be doing.
Great, thanks Conor. So we're going to go to our first presentation now. As I say, keep questions coming in and we'll address them after the presentations, but we're going to start off with Matt Cooper from Places for People.
Thank you. Thanks, Luke, and good afternoon, everybody. I mean, in terms of Places for People, for those who don't know the group, we're an integrated property and residential management services company. There we go. The business is split into two. We have a regulated business, which includes place people homes and common or other RPs, and then we have an unregulated business, which includes some PRS, leaseholder management, and leisure businesses, and that's mainly focused. There's some development in there. It's mainly focused on sort of long-term contract management. In terms of size, the turnover of the group last year was £600 million, and that's broadly split equally between the regulated side of the business and the unregulated business. I think on that split, we had an IDA from the HCA earlier on this year, and they were comfortable with the way we'd split the business with no recourse from the to the social housing assets from the unregulated side of the business. But obviously, the long-term aim is to get the cross-subsidy from the other side of the business into the regulated piece, which is obviously government grants are going to come back anytime soon. In terms of Brexit, as Luke said, it's still early days, and the biggest impact so far has been the Bank of England's announcement, which some called the kitchen sink approach, obviously the rate cut and the increased QE. I think that's the piece that we're sort of focusing on. In terms of, Luke said about crystal ball gazing, I'm not very good at that, and especially this has been recorded, so I won't give you any crystal ball gazing. In terms of risks, the key one is clearly the reduction in interest rates, which we hopefully you'll see in a second on the graph. Here we go. So, I mean, as everyone knows, 10-year swap rates sort of collapsed, and that's a lot of people in the sector and across the corporate world have interest rate swaps, and a very large increase in reduction in the valuation, leading to sort of cash calls. But I think on that side, if you've got vanilla interest rate swaps, it's quite easy to work out what potential impacts could be if rates go to 1, 0%. You can sort of do that on the back of an envelope. I think that's, rather than getting too funky and looking at too much of a statistical modelling. I think if the book's slightly more exotic, you need a bit more risk management around that. But it's still the same logic. You can always look at the worst case and say, what happens if, and then make sure you've got a mitigation scenario in place to sort of counter that. On the flip side, I mean, Lou said before, we have a diverse base. I mean, PFP has non-sterling debt as well. We've got issuance in dollars and other currencies, and that on the back of the Bank of England announcement, sterling collapsed, and for us actually, because we've hedged our foreign currency debt back to sterling, and that's meant that the cross-currency swap, the valuations on those is actually going in our favour rather than going against us, which I guess is sort of helpful. But I think the point to note on that is that you can't assume that's always the case, and we do the same stress testing and the same sort of scenario analysis on our FX side that we do on interest rates. Again, they're vanilla swaps, so it's quite easy to work out what happens if cable drops to 1%, to 1, or if it goes up to 2. So you can do that analysis quite easily, and that's sort of obviously key. And looking slightly more interestingly, looking at opportunities. I mean, the collapse in the gilt yields and the increase in QE obviously gave an opportunity for potential issuance in sterling, and there are lots of corporates that dived in pretty soon after the rate announcement. And you need to be responsive to these things and move quickly. I mean, at PFP, we have an EMTN program that's been in place for the last 10 or so years, and that means that when we do an issuance, we haven't got to go through the whole process of getting the legal docs in place for a standalone issuance. It's all there and agreed, and we can sort of do things pretty quickly. We also, since 2009, all of our public debt issuance has been unsecured, and that means that when we see an opportunity in whichever market we're operating in, we can issue pretty quickly. We don't have to go through the whole protracted legal process of getting properties into charge, which is a bit painful, as many people will know. We have an unencumbered asset test on our unsecured debt, so there is property there. It's just not specifically charged to the debt. And we have funding diversification. As we said, we have issuance across private placements and public issuance in different markets, and that means that when there's an opportunity that comes along, we can jump into that, and we're not focused just on bank debt or just on capital markets or even just on a specific geography. In terms of, as Luke mentioned before, we did a bond issuance the week after the Bank of England announcement. We borrowed £400 million for 10 years on an unsecured basis, and the coupon on that was 2.875%, and that was very well received. We had interest from over 160 different investors. That was in the UK, in Europe, and also overseas. And I think some of the work we've done in the past, engaging in different markets, really helped to sort of get the interest building, get the sort of place people name out there and get interest in that book. And I said 2.875% was a pretty good coupon. I think if anyone has a business plan that assumes 10-year funding is going to be even less than that, then I think it's slightly wacky. So obviously everyone's pleased with that, and that gives us pre-funding for the business plan, also reduces refinancing risk in the sort of upcoming stuff for the next couple of years. So in summary, I think, in Brexit, as with anything really, you need to manage the risks, keep an eye on the cash, because that's our job really. But I think just as importantly is taking advantage of opportunities. We are, the country still needs new housing, we need development, and if there's opportunities to get funding in place at very, very cheap levels that we can then use to sort of grow the business and increase the housing supply, then we should be making sure that we're doing all we can to get the business in that position and take advantage of those opportunities. So that was it from me, and I'll hand back to Luke. Thank you.
That's great. Thanks very much, Matt. And we're going to move straight on to Peter now, who's going to talk about the family Mosaic perspective.
Thank you very much. Peter Armstrong here. Welcome to everybody this afternoon. Just need to move my slides over. Good. So I thought I'd start off by going through what I've seen happen post-Brexit and a summer of change so far. While the holiday season flowed, customers continued to spend in the high street, but nothing too visible relating to Brexit. The service sector, sitting at 80% of the economy, displayed a record rise. General customer confidence has improved following the gloom stories during the Brexit campaign. However, nothing much has happened. CPI is still at all-time lows. UK manufacturing has seen a surge mirrored in Europe, with growth best in the last 7 months. The Bank of England, obviously everybody's aware, stepped in early to support the economy. I remember pre-2007, when I was a member of the Bank of England, East of England Information Panel, where they commented that any shift takes at least 6 months to wash through for impact. So I'm happy that they've stepped in early and shown their hand early. We wait to see what happens within the market. The drop in gilt rates will increase pension deficits. How much will depend on the mix of investment between gilts and shares. That's one for us in the sector to watch, seeing as pension deficits are seemingly quite high at the moment. The UK has become much cheaper in the for foreign investors, with 12 to 15% drops in the value of the pound. The currency effect on imports may have a lag until the benefit of companies' forward currency agreements expire, probably post Q1 2017. Holidays definitely got an immediate hit on that. I was getting less than a euro for my pound in the days shortly after Brexit. House sales, while the market still sees movement in the middle range, above that I've seen some stagnation, maybe the holiday season, but our views are that in the long term, 12-month period, we expect some recovery back to where they were. Impact on costs, well, we've already seen food and raw material increases with immediate rises hitting consumers' pockets. House building, very important for us. Both land prices and material costs have been rising for some time. So Brexit has confirmed that trend, continuing with increased costs in both materials and land prices. We've seen some breaks on house building, but the expected sales drop hasn't happened, and sales have actually held up. We haven't yet seen a slowdown in our own market. Although unemployment figures show good news, they do relate to June. There are a number of swings taking place. Lloyds announced 3,000 losses, although that was announced pre-Brexit. But on the other side, Arm, Glaxo, and McDonald's are showing gains. I think it's probably too early to tell what's really going to happen in the market. Britain lost its AAA rating, as we all know. And in our sector, we're mostly all on negative watch, but still rated A1 negative, so that's not too bad for going out into the bond market. Share prices obviously dropped, but recovery has happened, and we seem to be trading at a higher rate than we were before. So it's only 3 months, and that's during the holiday season. So forecasting is probably fairly challenging. There has been an overall drop in the pound, some 10%. The currency cost of food and raw materials, as previously mentioned, is moving up and will move once corporate currency hedges expire. The cost of house building has always had upward pressure, and we don't see that is going to drop off in the near future. We think probably there'll be pressure on lower paid wages. We have a fairly high care and support business, and possibly as European individuals move back into Europe, there will be a pressure on finding good staff to carry out lower paid work, particularly in care and support, and that could be an area where there is a rise in the cost of pay for that operational area. However, there's an ongoing low interest rate. We don't see that the interest rates are going to rise soon. The Bank of England has stepped in at a very early stage, and for us, overall, it's going to prove to be a fairly comfortable position for the funding strategy that we've got. That said, it will be balanced against the rising cost of both finding land and the raw material costs during the build process. Fanning Mosaic in total, well, we're a member of the London G15. This does, and we're continuing to build homes. We're definitely open for business, and it does, we recognise, come with some risk. We use quite a bit of open market sale to support cross-subsidy for the provision of general needs homes. But we do keep tabs on the market changes and work within the parameters of a stressed environment. For us, we actually look at what would happen if there's a 20% price fall and a 2-year sales delay. Obviously, we therefore need to look after liquidity requirements and the financial covenants that sit behind our bank funding. But we're managing to cover that exposure and maintain the way in which we look forward with those stressed scenarios to ensure that both liquidity and covenants have plenty of headroom. For cash calls for us, there's a specific, which is something that the industry is looking at as interest rates are dipping to all-time lows. Well, for us, we don't have very many standalone swaps. Most of what we do is bank debt, fixed rate funding. And lastly, we in London see that the demand for housing is high, and the fundamental lack of supply and low interest rates are keeping prices buoyant. So for us, we're definitely in there to build more homes to support what is required for the London marketplace, and we don't actually see at the moment anything that is causing us any concern or exceptional stress. So thank you very much, Luke. Back over to the rest of the panel.
Excellent. Thanks very much, Peter. And we're going to go now straight to Nick, who's going to offer us the perspective from Lloyds.
Thank you, Luke. So yes, I work for Lloyds, and obviously Lloyds is a big supporter of the social housing sector. In fact, we have a total of 12.5 billion of commitments outstanding to the sector at the moment, and the sector does, of course, play a crucial part in Lloyds helping Britain prosper plan going forward. And in fact, we've pledged to help the sector to the tune of £500 million per annum going forward. So personally, I work in the financial markets division in Lloyds. Some of you may know some of my colleagues in that division, such as Glenn Manning, Ari, and Andrew Sterling. We're focusing on risk management for housing associations. So I thought today I'd briefly touch on a bit of a market update in interest rates and then talk about some of the implications of that. So moving on to the first slide, which is the rates market update. We have, of course, been looking at lower yields recently, as my other two presenters have touched on there. The main reasons for the fall in yields in the past year, and in fact since Brexit vote happened as well, are mainly dovish global monetary policy and also demand for yield from investors. So as has been mentioned previously, the Bank of England did, of course, ease monetary policy at their August meeting. They cut the bank rate from 50 basis points to 25 basis points and announced some additional bond buying. So the graph on the right-hand side of this slide, the top right-hand graph shows global central bank policy rates. So you can see across UK, US, Eurozone and Japan, rates are at zero or very, very close to zero. In the bottom right-hand graph, this is the central bank balance sheets again across Bank of England, US, Europe, and Japan, and you can see all the QE programs essentially are increasing. The one that stands out there is the grey line, which is the Bank of Japan. So you can see the last 3 years, the Bank of Japan has massively increased its own QE program, and it's running currently at 16% of the GDP of Japan, which is a very big number. Obviously, Japanese GDP being considerably bigger than the UK GDP. So the Bank of England is now in sort of wait-and-see mode in terms of what that means for the UK economy. But in terms of what's happened to 20-year government bond yields, I've just got those graphed on the bottom left. So this is the sort of, again, the global context of 20-year government bond yields. So we have the green line is the UK 20-year gilt yield, and then the blue line, light blue line is Germany, grey line is Japan, and the dark blue line is Switzerland. So you can see that rates have, in fact, in the UK, the 20-year gilt yield has fallen roughly 1% since the Brexit vote. It's coming closer towards those other three economies. I chose those three economies because they already have existing very low rates. So you can see Eurozone and Japan already close to zero, and in Switzerland, in fact, the rate on the 20-year Swiss government bond is already negative. So what's driving those yields down? So the monetary policy, but also, I guess, especially when you think about the context of Japanese investors, the Japanese government has been buying up their government bonds. So they're now looking globally to other government bonds. That's driving down the yields of UK government bonds as well. Obviously, as gilt yields decrease, that does impact swap rates as well. So I thought it'd be worth touching on the impact on clients that have transacted historic interest rate swaps and what this fall in yields mean for them. So moving on to the second slide. So we're taking here the example of a 25-year interest rate swap that was traded back in 2011, so 5 years ago, with a rate of 4%. So client would have been paying fixed at 4% against receiving LIBOR, that being the predominant rate at the time back in 2011. So just talking through this graph I've got here. So essentially the solid green line is how that mark-to-market would have moved roughly until September this year. So you can see it's moved considerably negative. From that point forward is what might possibly happen to rates. So the dotted green line is expected mark-to-market, if you like. So we expect if the interest rate curve is followed, the mark-to-market to gradually decrease. However, there are some scenarios where it could decrease more, and there are some scenarios where it could increase more and could become more negative. So this is clearly one of the risks facing housing associations that do have existing swaps in place. So just talking through some of those lines on that graph, the dotted red line is what we have as the 95th percentile path in mark-to-market. So that's saying 1 out of 20 times the mark-to-market would move in this kind of fashion. So that's a fairly extreme move, and that would involve actually scenarios where rates go negative. The other three lines in between the green and red line are saying, well, let's say the sterling level of interest rates fell to a level either that we currently have in Eurozone, Switzerland or Japan. What would that mean for mark-to-market? So again, you can see that all those three scenarios would imply, again, a further sort of fall in mark-to-markets to become increasingly negative. So, okay, so that's all well and good. So what happens if rates do go negative? What does that mean? So I guess accounting-wise, it means greater liabilities on balance sheets. Also, in terms of collateral, for those housing associations where they do have collateral agreements in place with their counterparties, it would mean having to post more collateral. So you know that has implications for the amount of unencumbered property within the association, and also implications for liquidity. If there's not sufficient property collateral, then cash collateral generally be posted, so that would have implications for the use of that cash, liquidity within the organisation, the possibly stopping the cash being used in more profitable enterprises. I guess in terms of, we should touch on the benefits of low rates as well. So what are the opportunities? Well, of course, low interest rates present an excellent opportunity to fix the cost of any unhedged debt, or indeed to extend the duration of any existing hedging from existing tenors out to maybe longer term. Because rates are so low, you can take benefit of the low rates there, and also, as Matt alluded to earlier, sort of issue fixed rate debt at what would be historically very low coupons. So I also just wanted to touch lastly on what we can do if we are concerned about rates going lower, mark-to-markets going increasingly negative. So how can we limit further mark-to-market moves? So one of the alternative solutions would be to buy a swaption that gains in value if rates do fall further. I've modelled, if you like, the impact of what one of those swaptions would look like. What I've chosen is an option to receive fixed under a swap at 0%. So what that means is if rates go below zero, then that option becomes in the money. So it would therefore increase the mark-to-market and offset the increase in negative mark-to-market from an existing swap transaction. You can see on the graph that the potential exposure from the dotted red line is the same potential exposure we looked at a couple of slides ago. The two lines above that, the blue, dark blue, and the light blue lines represent the exposure that could happen, or the mark-to-market that might happen if you've also bought some swaption protection. So the reason I've got two lines in there, one would be a 100 million swaption, one would be a 50 million swaption. Clearly, the 100 million swaption would cost more premium upfront to buy, but the offset is that the more you pay on a premium of a swaption, the greater the protection you have. Alternative solutions to limit further mark-to-market moves. I mean, that's not the only thing to do. Also, you could close out some or all of the existing hedging, or possibly refinance bank loans and swaps with fixed rate debt. Obviously, Lloyds is happy to discuss any of these with your treasury teams going forward, and happy to have a conversation. So that wraps up what I wanted to say, Luke. So back over to you. Thanks.
All right, great stuff. Thanks very much, Nick. So there you go. You've had all the presentations. We've had some questions coming in as the presentations were made. We've now got half an hour to run through the Q&A and discussion. So we can start with the first one that came in. There was a question which was, is the main threat to the sector from adverse impacts on the financial markets? So that's a kind of risk mapping question. Can we just run through the panel there and start off with Matt?
Thanks, Luke. I thought you might say that. I mean, I think at the minute probably is. I mean, it's, as I've said, we're not quite sure what's going to happen when we're going to start the Brexit process. And at the minute, I think the main impact is on the back of the Bank of England's announcement, which has been predominantly focused on sort of rates and FX and the treasury side. I mean, longer term, probably not. I mean, I think that there's a limit to how much risk management you need to do, obviously, on the sort of the Brexit side. I think most people will be in a position of knowing what the risks are. Now, I think longer term, there probably is a broader threat to the sector on the back of. I mean, there'll still be demand for housing. I think whatever falls out from Brexit, the demand will still be there. I guess it's just a question then is how does this meet that demand? Or rented or sort of, as Peter sort of a mix across the piece, really. So, I mean, I think in answer, I don't really know what the answer is, but I think at the minute it's starting on the financial side. But I think longer term it will migrate over to the sort of broader business, and there'll probably be a bigger threat than that.
Okay. I think Matt, I think you might have been drifting in and out a little bit there in terms of the sound, but so apologies for any audience members that couldn't quite hear some of that. But if we can move just on to Peter then with the same question, Peter. So the main threat to the sector, does it come from adverse impacts on the financial markets?
I don't think so. When the last recession hit, which I was in the middle of because I was doing securitization work, it wasn't. I suppose that was more about a sudden drop in liquidity. I think there is an investor market out there, particularly for our sort of funding requirements, which are we're fairly sound businesses. We've got a long-term requirement for debt funding. I know we're not necessarily across the whole board of the sector frequent issuers, but I think we are there as a backstop for those investors that want to go and grab hold of an investment with us that is for the long term. And I think I haven't seen a shift in the availability of liquidity. Not that I've actually done a bond transaction at the moment, but I see within banks, we say that we're up for business, and the banks seem to be offering to support that. Matt's just been out with a fairly hefty £400 million hit. In the past, I've been advised that once you go above 250 million, you might find that investors are dropping out. Well, that's now proved to be not the case. So for us, do I think liquidity or what's going on in the investor market post-Brexit will give us a great deal of difficulty? I really don't think so.
Okay, thank you, Peter. And yeah, the same question to Nick.
Yes, I think in terms of obviously funding is a risk. As Peter and Matt have alluded to, the bank market is still there. Lloyds still supports that sector, as do other banks in the UK, especially. There's obviously still strong investor demand for bonds, for public and private bonds. So I think the funding aspect is still there. Obviously, that's potentially at risk if financial markets worsen or we have some bad news, or etc. I think in terms of other risks, there certainly are other risks. Possibly regulatory risk and house price risk. I guess a lot of that would depend on the business model or the individual association. So the more you're exposed to, I guess, sales risk for developments, for example, then I guess you're more exposed to house prices. Possibly a little bit more cyclical, so exposure to the economy as a whole, which is clearly linked and correlated to financial markets performance as well, than if you're looking at more longer dated assets or longer dated funding and contracts, etc. So I think yes, broadly, financial markets of course will have an impact, but potentially it can be limited by the business model of the individual association.
Great, thanks, Nick. I mean, there was another question which has just come in a little bit later. I think you've all pretty much answered it, but just to clarify as well. So the view is that the real long-term Brexit impact is yet to come. Clearly, Matt, start with you.
Yes, no, I agree completely with that. I think the impact we're seeing now is what the Bank of England is doing to try and stave off a recession. But in terms of longer term, the impact hasn't started yet, and possibly won't do for the next 6 months, depending on how the government wants to play Brexit.
Just to wrap another kind of question into that, though. So there's been another question from the audience asking around stress testing and how Brexit has impacted that. I know Peter and yourself touched on this a little bit in the presentation, but to what extent has your stress testing changed, if at all, as a result of the Brexit vote? And what kind of eventualities were kind of in your scenarios that have now come into play or will come into play, do you feel, in the 6-month period?
Yeah. Well, we have for some time monitored market sales, because as grant income has reduced considerably, we've been subsidising the capacity to build homes for those that can't afford it. And actually, our average rent's around about 40% of market, which we feel is the affordable level that sits within our area of operation in London. So to do that and to cross-subsidise, whether it's through market sale or through shared ownership, both of those have sales risk attached to them. So we take a very simplistic view, and we ensure that at all time we have headroom, both in liquidity and the aspects of the banking covenants that we have to adhere to, that we can take what we've seen as the last previous recession profile, which was that sales dipped for 2 years, and there was a stagnation of being able to sell for 2 years. So we haircut our assets by 20%, all of our market sale assets, and then we look at what happens if we don't sell anything for 2 years once that recession hits. And we just make sure that we've got enough liquidity and we've got headroom in our covenants to enable us to cover that. We don't want to venture into a build program which would put our business at risk, because we are very risk averse. We're very well governed. I haven't seen that the regulator has taken a foot off the pedal in maintaining control over what we really do. So be it that there may be soundings that may change, but in essence, we're very risk averse. We're not profit-making organisations. We're here to support the needs of our charitable needs and the visions that we follow. So, we keep a very tight control over it all.
Thanks, Peter. Matt, sorry, go on.
And actually, it hasn't changed in the last 3 years. That's the way we've been working. Brexit may be putting some changes into the value of market sale, but there's such a demand in London, and with interests at all-time lows and not expected to rise over the foreseeable future, then we see that we will still be able to continue to sell property in the area in which we operate. Thank you.
Great, thanks, Pete. So going over to you, Matt, on this question as well, kind of how the Brexit vote has impacted your stress test scenarios.
I mean, I think from an interest rate perspective, the rates have been where they are now in the past. So I don't think an easy stress test is looking at that, and that hasn't necessarily changed in terms of sort of worst case. The same on the FX side. I mean, I think in terms of development, we don't have a massive development part on, especially not in London. So we're sort of slightly less at risk of sort of a collapse in the housing market as maybe a sort of a G15 would be. But I think, in terms of how it affects the stress test, it's still a bit. I think in the business plan, you sort of assume for what we thought Brexit might look like, and we're still not quite sure what it looks like now. We're almost in a similar position to where we were before, apart from the fact we know it's now going to happen. So I think there's a bit more work to do on the upcoming business plan to make sure that covers things up. But until there's a bit more information available, it's still sort of looking at the worst cases, which is what we were doing last year and probably the year before that as well. So I don't think there's been a massive immediate change. But obviously, as we sort of alluded to before, as the economy changes, we may have to look at the business, and if that then starts to change, we'll have to obviously factor that in. But I think for now there isn't. It's still looking at the same sort of stress scenarios as we were 6 to 12 months ago. But with that, okay, the assumption that it might stay lower for longer.
Okay, thanks, Matt. We're just going to. It's got another question, really, just on continuing the kind of stress testing topic. Peter, can I go to you on this one? Just I think you kind of touched upon this, but can you draw out the kind of key market indicators that you're monitoring in the property market?
Yeah, in the London property market, we operate in a constrained number of boroughs. So we make sure that wherever we are marketing property. It's an area of operation that we have quite a few homes in, so we know it quite well. We understand boroughs and actually streets within boroughs, so we go down to a level of detail that enable us to watch what's happening. We're particularly interested in transport hubs. So in general, we look at what's happening. Our key features in marketing is that we don't sell when built. We try and pre-sell everything we've got. So we get in and put up the showrooms, show homes to show what and market what we're going to sell some many months before that build process has actually been completed. And in fact, throughout this year for us, which is 16-17, we will have pre-sold the majority of the units that are coming to the market. So I suppose monitoring what's happening is by being on the ground, seeing specific detail around the metrics of what is selling and what isn't. House prices in London are still accelerating at quite a phenomenal degree. We ensure in the metrics to look at who is offering the mortgages for those properties. We do a lot of web internet sales, so we monitor the whole application base of the customers that are coming to purchase our properties, and then filter it down to those that are real buyers. So in terms of monitoring the metrics of properties, it's more about on the ground knowledge, because you do find that one property in one street sells better than one in another. Transport hubs and just generally how our regeneration process enables property prices to be accelerated. So in pre-selling, we will have sold into an opportunity for our purchasers to take the value of regeneration. I don't know if that answered the question, but the metrics are very detailed.
No, that's great. Thanks very much, Peter. It's really interesting. And Matt, so same question to you around the sort of property market indicators and the key measures that you monitor.
I mean, I think in terms of the property market, clearly you can monitor where the market is and to look at what could happen in the worst case and what happens if values fall. And I think that's sort of falls into the whole stress test. And Fletcher People is a diverse business. It's not just sort of housing association and property management. So we've got sort of a mix across different sectors. I think that helps to sort of insulate us a little bit from some of the risk, especially from the sort of the housing, the risk of specifically on the housing market, as Peter was saying. So I think it's monitoring broad economic indices. It's quite hard to pin your hat on one or two that you definitely look at. I think it's looking at the sort of the market as a whole and working out where the opportunities are and where the risks are, and making sure that if other risks do develop, that you're sort of monitoring those and focusing on those. It's quite hard to pin your hat on one or two things because it's not in chartered waters. It's quite hard to know where we are. I think if the business is flexible and can adapt when markets change and when opportunities arise or sort of when opportunities move away, I think that's the best way of doing it, rather than sort of pinning your hat on one or two things and then sort of looking things down.
Okay, great. Thanks for that, Matt. I've got a couple more questions, still on the kind of the development side and construction. Actually, these kind of tie into the impact on migration. Actually, so there's one which asks whether there are genuine fears that a reduction in a skilled workforce is going to impact the delivery of the homes needed. And well, I mean, the second question really repeats that. It's is the medium-term risk to housing associations from reduced migration as a result of Brexit causing reduced pressure on the need for housing? Peter, sorry, if we can go to you on that one first.
So I think that question is all about people moving from country to country. Yeah. Well, we feel that there will obviously be an upward pressure on low income wage profiles as the capacity reduces. There will be an upward pressure on how much people want to earn. That in the construction industry is going to be something that will give rise to a certain risk, and also for us in care and support, we will see upward pressure on the payroll, where it is at the lower end of the income scale for the individuals that are employed. So there are two areas for us in risk. However, do we think that that's a terrible thing? If the general shift in wages is upwards, then hopefully the benefits received by those receiving the care may shift up a little bit. And in the build profile, it's hard to say. Could I hang my hat on and say it's going to do anything to our pricing that we could actually understand? Well, no, because we've seen that for a number of months land prices have gone up, and so has build costs gone up. And I think that the biggest issue for us will be cost of raw materials going into that build process. And is there enough land around for us to continue our build program? So if there's anything the government can do to assist the delivery of new homes, is for them to find a route to release land in a fashion that would allow us to carry out those builds, rather than looking purely at labour costs that sit within that whole programme. So
Great, thanks, Peter.
That'd be my
Can I quickly go to Matt on that, just for a brief answer? Then I want to bring Nick in on a different topic around hedging. But Matt, just quickly, just on the migration topic, what's your view on the potential impact there on housing delivery?
Well, I think there is clearly a risk on that. I mean, we're a very commercially driven organisation. If the numbers don't stack up commercially, then it's quite difficult for us to sort of proceed and do things. So there could be the point that we have to reduce what we're doing to make sure that things still stack up. So I think there is clearly a risk, but as with these things, there are lots of risks coming out potentially from Brexit. It's quite hard to know which ones are going to happen and coming down, what the impact will be. So I think, as I said before, being sort of flexible, being fairly nimble, and not focusing all of your eggs in one basket is a sort of a way to sort of diversify the risk, ensure that we can keep delivering what we want to deliver, but doing it in a commercially sort of risk managed way.
Okay, great, thank you. Bringing Nick into the discussion. We've got a question from the audience here, asking about how actively housing associations are restructuring their hedges at the moment. There's some interest in whether people want to do that, given what we've seen with mark-to-market positions and people being out of the money in the current climate. Nick, have you got a view on that?
Yeah, so I think we're seeing, housing associations being fairly active in restructuring, and I guess, be that in terms of just extending duration or restructuring for accounting reasons, for example. But I guess, longer term, there's possibly a mix of change in the mix of funding from bank debt and hedging towards more capital market debt or private placement debt. So, obviously, given that backdrop, I'd expect the overall level of hedging to probably reduce going forward. And that would obviously, possibly alleviate the problem a little bit. And obviously, we've spoken about possibility of rates going lower, but clearly we are already at a pretty low point in rates. So if hedging now with brand new swaps, clearly rates could go up as well, right? So if inflation starts increasing, then you could well see rates go up rather than down from here. So that could obviously be in the favour of pay fixed hedging. So I don't think people are particularly off put by the potential mark-to-market of brand new hedging from here. I mean, I think if anything, the levels are pretty attractive. Obviously we are pretty close to historical lows in long-dated rates and in fact in short-dated rates as well. I think it's just obviously since the Brexit vote happened, obviously it was certainly a big shock for markets, certainly initially. And you have seen some pretty big moves since then. Let's not forget. So big falls in yields, big movements in the FX, in sterling dollar and sterling euro. So I think people have adjusted to that. And one of the adjustments was in fact thinking, well, actually negative rates is on the horizon now. It could actually be a possibility, whereas in the past it had been possibly a little bit discounted as well. That's a problem for Japan, that's a problem for the Eurozone. I think it's coming to focus here. Certainly from our discussions with clients here, more and more people are a little bit more concerned about that going forward. And internally here within the bank, we obviously you had a discussion around stress tests there. That's one of the things we're thinking about here now. So I think it's a bit of a new paradigm since the big market moves we've seen. But I think the thing to remember is it's definitely a good opportunity to hedge from here, and because rates are a very good value, I think, either in terms of hedging or in terms of just outright bond issuance.
Great, thanks, Nick. I mean, is it possible to offer any kind of comment on we've got kind of 49 housing associations out there with standalone swaps at the moment and kind of obviously out of the money. I mean, how advisable is it for people just to take a hit on a break cost and to kind of exit, or is it really just a case by case? Is it possible to say anything about that?
How vital is it? Well, I mean, I think it's certainly viable. Yeah, I mean, certainly if that's the right thing to do from a risk management perspective, and of course, that's something that that can be done, of course. But as I said, it's how do you fund that? I guess there's going to be an upfront cost for breaking that. And maybe the better solution is to partially break, or reduce the notional, reduce the maturity somewhat. Maybe and the bank debt going forward, I think, is going to be not 20-year funding. I mean, obviously we have at Lloyds considerable amount of long-dated loans out to housing associations. I think going forward, what we've seen is the maturity of bank debt reducing to more like 5 years or something like that. So that's going to change the hedging profiles going forward as well. It might mean that some of the swaps are reduced in maturity from 20 years down to more like 5 or 10 years to match the bank debt, as the long-dated debt is refinanced with bond issuance. But of course, these are all there's lots of possibilities of how the financing and the hedging can work, and of course, as a counterparty, we're open to any discussions of how counterparties would like to change their existing hedging.
Great, thanks, Nick. I mentioned at the start there might be a bit of crystal ball gazing, and we got a question which is, what is the view on rent policy post 2020? So can we just go through the panel on that, please, starting with Matt?
Thanks, Luke. I mean, this is a almost impossible one to guess. I think. I mean, personally, it's hard to. I mean, I think given all the changes in the government and given where we are, I think it's almost impossible to know where we're going to be. I mean, from our perspective, we've taken out the cost to ensure that we can sort of maintain margins even on the back of the 4 years of the rent cut, which is pretty much what we can do now. And obviously in the stress testing, we can run a variety of scenarios and look at what happens if we have further 1% or even more. But I think in terms of what the view is, I'm not going to say anything that's been recorded on where I think rents are going to go, because that's a dangerous game.
Fair enough. Peter, over to you.
Certainly. From our side, we got hit rather heavily because we're already only at 40% market rent. So take another 1% out of us, we felt a little bit upset about, but it wasn't it didn't seem to be fair right across the board where some HAs were charging 80% market rent. But for us, I suppose to make sure the business planning isn't too far adrift, we possibly may think about CPI uplifts only, not anything accelerated above that. So for us, we do look at risk scenario stress testing that looks at what happens if the 1% reductions are continued further out. But in the main, without a crystal ball, as Matt was saying, it's pretty hard. Not taking off the record that not to expect anything above CPI might be a reasonable assumption. That's
okay.
it.
Thanks, Peter. Nick, do you fancy having a crack at this one?
Yeah, thanks. So, I mean, what I would say, I'm obviously not an expert in how the policy might turn out. What I would say is, obviously, in the past, we have seen certain housing associations hedging the inflation uplift in their rents with us. So, clearly, the more linkage there is to CPI going forward, then there's a possibility to hedge that, swap that into a kind of fixed uplift going forward with your bank counterparties. In the past, there has been some RPI linkage. I think going forward it would be more like a CPI linkage, but that's also possible to fix by the bank market as well.
Okay, thanks for that, Nick. Would you believe we actually almost hit 1 o'clock? So we are coming to the end. I'm just going to pass to Conor for a quick run through, and then I'll come back and wrap up very quickly.
I always say thank you to all the panelists, especially Matt, Nick, and Peter. Thanks for your input. Thanks for the answers to the questions that you've provided. Also, thanks to Social Housing Magazine, Luke Cross, and Joe Dart. We work with Finance Active to develop high-quality software solutions to optimize debt and financial risk management, including but not exclusive to loans, FX, swaps, hedging, financial forecasting, and guarantees. We remain open for business and we are committed to the UK market. The underlying message from today's webinar is that a lot of the risks seem to be relatively well known. This means that the heads are not being stuck in the sand in regards to the possible risks. When one of these scenarios does play out, the leaders of the UK industry need to ensure that these heads do not plunge back into the sand. The housing associations have reviewed these possible scenarios, and it is imperative that their teams are agile enough to instantly react to market shifts. In order to do this, the teams need to be equipped with the proper tools and the right information at the right time. Just to sign off will be keep calm and carry on preparing for when you will be needed, because it will be coming. Back to you, Lee.
Great, thanks, Conor. So you just kind of stolen one of my sort of slogans there. But so how to summarise? I'd say open for business, take opportunities, and manage risk. Be ready to absorb a market shift. I suppose keep calm and carry on is one of the key messages. So we hope you found the session informative and useful. Just to remind you that a recording of the session will be found via our website, www.socialhousing.co.uk. That will be posted shortly. Feedback is always welcome to help us with future webinars and discussions, so we'll be sending a survey out of a feedback form out to you. Finally, thanks everyone for listening in and for taking part and for all of the questions. And of course, a huge thank you to our panellists and to our sponsor, Finance Active. Enjoy the rest of your sunny afternoon and goodbye for now.